I'd like to welcome everyone to the third installment of a group of four webinars that we have targeting our very special business owners. And today we're excited about this, as we were in the prior one, but especially today, because the topics are going to be focused on you and will allow you to actually take action and apply some of these tools to your own practice. So what I want to do is to formally introduce each of the speakers that we have. We'll be doing that as we move through the presentation. But first, I'd like to introduce the incomparable Ryan Beckley and Joe Cordonke. Joe's the manager of our commercial loan origination, and Ryan is the senior relationship officer. Gentlemen, if you would, the virtual floor is yours.
All right. Thank you. It's a pleasure. If we could go to the next slide on the presentation. Yes, that's it's me. That's Joe. Joe will be speaking after me. My name is Ryan Beckley. I've been with Kinecta for 7 years. I'm a senior business relationship officer, and my job is to originate commercial loans. Specifically SBA loans, small business loans, and commercial real estate loans. I've been doing this since 2005. I've worked with banks and credit unions and have a lot of experience when it comes to financing small businesses as well as commercial real estate. So let's get started. Let's go with the first slide of the types of SBA loans. And first, the SBA was created in 1953. With the Small Business Act, and its job was designed to help promote financing for small businesses that might not have been served by the current banking environment. Originally, when it first started, it was the SBA that was doing the lending directly. So your lender was the federal government. But over time, they stopped doing that, and they put more of the lending into the private sector. So that was when you started to have banks and credit unions, and then some third-party finance companies do the lending. And that's the way it is now. Now the way it goes is, as a business owner and a member with Kinecta or not a member with Kinecta, you can apply for an SBA loan directly with either the bank or the credit union. In this case, you would make an application directly with Kinecta Federal Credit Union. And you can find the first two forms for our application on our website at kinecta.org. After that, we can get into the types of programs that are offered by the SBA. So the SBA offers not only their standard loan, which is a 7A loan, it also offers an express line of credit that can be used to help support sales and accounts receivable. And it kind of works like a credit card. You borrow on it and you pay it back over time. The term loan is more of a borrow it once, and then you make amortized principal and interest payments over the life of the loan. And then you can also use the SBA loan to buy real estate, what we call owner-occupied real estate. So what this looks like is you're a business owner, you own your business, and you're leasing a facility to run your business out of. Perhaps one day the landlord offers you the opportunity to buy that space. Well, you can go to the SBA, and with the down payment of anywhere between 10 to 20% lender dependent, you can qualify and begin the application process to purchase the commercial real estate and own it for your business. Those are the majority of the loans that we do at Kinecta on the SBA side. We do 7A term loan, and we do the express line of credit, and then we do the commercial real estate loan for owner occupied. Usually on the real estate transactions, those require a down payment between 10 to 20%, and then Kinecta would finance the rest of it. If you can go to the next slide, we'll talk about use of proceeds. So this is kind of the what you're going to use the loan for. You've been approved for the loan, and now this is how we're going to use it. First step is working capital. This is going to be used to help you buy raw materials, to help purchase inventory, and also help cover, some of the expenses associated with making sales. That can be hiring people for payroll. It can be covering insurance costs. can help with marketing, advertising. All those components can go into the use of proceeds of working capital. The next thing is you're going to purchase equipment. So this is going to be not just necessarily computers and stuff, but if you're a manufacturer or even a service-based company, you might need equipment to provide your product or service. The SBA allows you to do this, and the nice thing about this is you can get a 7 to 10 year maturity on the purchase of the equipment. The next step is to purchase of real estate, which I discussed previously. That's owner-occupied real estate for your business. Business acquisitions. Say you're a business owner and you perhaps have an opportunity to purchase a competitor, or you're just wanting to get into this line of business, and perhaps you've worked in the industry for a while, and now maybe the owner of your employer is willing to sell the business to you. So we do business acquisition loans. Once again, this is going to have a down payment capital injection component to it. So we're going to look for 10 to 20% capital injection on the acquisition price. Business acquisitions tend to take a little bit longer because we're dealing with a buyer and seller. So these transaction times on something like that is around 90 days. But you can get an SBA loan to purchase a business. The next step is going to be debt refinance. Say you got a term loan for your business at a higher interest rate. Say it was at 15, 18%. Well, as long as it's a qualified business debt, not personal debt, if it's qualified business debt, then what we can do is we can refinance that and get it on a better term. Like I said, 7 to 10 years. Tenant improvements, what that's going to be is improvements to your space. Maybe the space you're occupying it. Maybe, when you moved in there, it wasn't the greatest conditions, but now you are in a position to do the repairs and the improvements pending landlord approval. This can also be if you're moving spaces and you need to build it out, so to speak. Put some walls, restrooms, offices, items like that. Tenant improvements can be used for it. And then the next step is going to be the line of credit. This is what I mentioned previously with our express line of credit, where you can borrow it and then you pay it back. And we do review those lines of credit because we want to make sure, hey, that the business is borrowing it and using it and paying it back in a timely manner. But we do have the flexibility of providing a line of credit with an SBA loan. Can you go to the next slide, please? All right, so some of the features of these loans. One is backed by the U.S. Small Business Administration. As I mentioned before, it's created with the Small Business Act. What does that mean? Well, what that means to the lender is that we get a guarantee from the government in case of a default. So that's usually a percentage of the loan amount. So if it's a $100,000 loan, we might get an 85% guarantee if we complete all the forms correctly and get the proper approval. And what that means is if there is a default, then 85% of the loan balance can be covered by the United States government, and which is also funded by the U.S. taxpayer. So what that does is it kind of allows lenders to take on possibly riskier type deals that they might not otherwise have done. And so that was kind of one of the features of the SBA program, is to help incentivize lenders to provide loans to small businesses. We're a preferred lender with the SBA. We're part of their preferred lending partner. And what that means is Kinecta will take the application, we'll underwrite it, we'll make a decision on it. If it is an approval, then what we do is we can get an expedited approval from the SBA. So the SBA says, you lender, Kinecta, approve the loan, and then apply to us for the guarantee for that loan amount. Well, normally, if you weren't a preferred lender, then you would have to compile all this paperwork and send it in, and it could take, an extra 30 days. But as a preferred lender, we can submit that approval and get a turnaround on it within 1 day from the SBA, and they give you a federal loan number that is then part of the loan documents. We can do up to 90% financing, as I mentioned, depending on the use of proceeds, like a business acquisition, purchase of real estate, even the purchase of equipment. The loan amounts. So the SBA, you can get an SBA loan for as small as $10,000 all the way up to the SBA max of $5 million. But SBA allows lenders to set those limits as long as you're within the SBA program. So what Kinecta has done is we're willing to provide SBA loans from $100,000 up to $1 million, even though the statutory maximums are larger. Just for Kinecta's strategy, we want to look for $100,000 to $1 million. One of the other things that we have is the applicant business must be in operation for a minimum of 12 months. So we're not doing startup financing at this time. So the business has to have been up and operating for a minimum of 12 months, and we'll verify that with a profit and loss and a balance sheet, or if you file your tax returns, then we can verify that with the tax return. And those are kind of some of the top line features of our SBA program. If you have additional questions, we can discuss that at the end of the webinar or with our contact information. So with that being said, I'm done with SBA lending, and I'm going to turn it over to Joe Ferdonsky, and Joe's going to talk about our commercial real estate product. So, Joe, take it away.
All right, thanks, Ryan. Next slide, please. Here we go. When people talk about credit unions, they typically don't think credit unions being involved in commercial real estate lending. I know up until I started here at Kinecta 12 and a half years ago, I certainly didn't. My background was in the B of A, WAMU, Chase, large bank industry. And so coming over to a credit union, again, was different in the fact that my perception was that they were more retail oriented and not so much commercial focused. But coming over here, we have created quite a large commercial real estate group. We are one of the largest commercial lenders in the United States as far as credit unions go. Our current portfolio that we maintain on our own balance sheet is around $900 million at this time. And so again, we've grown this business quite a bit, but in a very conservative fashion. We lend to commercial real estate investors and property owners only within the state of California. So the real property has to be located within the state of California. Typically we don't go out of state just because our core business here is located within California. We will go, down to as far, south as Chula Vista and as far north as Redding, and everywhere in between. Next slide, please. We keep our focus on what's kind of referred to as the 4 or 5 main food groups of commercial real estate. That's multifamily, industrial, office, and retail. We have carved a niche in the self-storage financing arena. So what that is that for those of us who are here in California, know that the self-storage industry is quite large, and you see them all over. And that is a very successful cash flowing business. And so that product type has proved to be very recession proof, downturn proof, as people are either upsizing and need stuff to put their stuff they don't need anymore, or downsizing. They need to store stuff that they can't fit in their new home. So again, we're focusing multifamily apartment projects that are in excess of 4 units, manufactured housing communities, which are also known as mobile home parks. And for those, the financing only encumbers the improvements. It does not take the individual homes into consideration, as those are typically tenant owned. And so the tenant owns their own mobile home, and then they pay a monthly pad rent to the property owner. And so that's what we look at from a cash flow standpoint as to what that pad rent is. Industrial warehouse, which is a very, very good product here, especially in Southern California, given the ports, LA and Long Beach, the distribution centers out in Corona in Ontario. And so that is a great product type in that it historically has enjoyed a very low vacancy rate, and is useful just given the industries in the area. Office, given the pandemic, office is challenging right now, as everyone is, mainly working remotely. Some are, returning to work, but the office market is a little tough. Seeing high vacancies, and the product that we are tending to shy away from, and until the market kind of smooths itself out. Whereas retail was kind of where office was in the beginning of the pandemic. Retail is again attractive in the fact that tenants and businesses that were going to be negatively impacted by the pandemic and lockdowns and so on, and what we call the Amazon effect, have the ones that are going to survive have survived. And so grocery anchored retail, obviously very, very attractive. Again, kind of Amazon proof retail that has the nail salon, the UPS store, the Metro PCS store, things like that, are very attractive, especially in a neighborhood setting. So Kinecta stays away from any kind of specialty commercial real estate, such as car washes, churches, gas stations, things like that may have an potential environmental issue, or aren't our typical investor type of real estate. If you could go to the next slide, please. So as I indicated, multifamily, we lend only on 5 units and over. Anything 4 units or below is considered still considered under the residential home loan umbrella. We tend to look for loans anywhere from the $1 to $10 million range. We have found that kind of the $3 to $5 million is our sweet spot. We will, unlike a home loan that amortizes over 30 years, a commercial loan has a maximum term of 15 years and will have a balloon payment at the end of those 15 years. But it does come with a 30-year amortization. So the purpose being that it maximizes the cash flow to the property owner. We use a fixed rate based on the Treasury rate, which those who follow it know that it is taken quite a leap, and so loans that were priced in the low 3% range even 2-3 years ago are now in the upper 6s and low 7s, and so that has greatly impacted the ability to lend and the dollars that we're able to lend. We'll lend up to 70% loan to appraised value. So we do look for 30% of equity in the property, and that is either in the form of value for properties that have been owned by an investor for a number of years, or actual cash if it is a acquisition. The beauty of a federal credit union, which Kinecta is that we are not permitted to charge any type of prepayment penalty. So other lenders, commercial mortgage-backed securities instruments, things like that, will often have some type of prepayment penalty, whether it's a step down, 5, 4, 3, 2, 1, or something like that, or a beast that's referred to as yield maintenance or defeasance. And so with those prepayment penalties, sometimes makes refinancing or sale of those prohibitive, just given the amount of what that prepayment penalty is. As a federal credit union, we're not allowed to charge a prepayment penalty, so therefore our product is very attractive for those people who are looking to maybe buy a property, upgrade it, establish some future value out of it, and then want to turn around and sell it, or maybe take advantage of the increased value and the equity in the property after a few years and then refinance it. So something that is very different and a great attractive sales point for us is, again, the no prepayment penalty. Again, Kinecta is very active in the commercial space, like I say, in California only. And even with this up rate market, are still looking to put dollars out the door. So any questions or maybe opportunities that you'd like to discuss? Again, our contact information is available. We would be happy to take a look at it. Thank you.
Thanks so much, Joe and Ryan, on that. I appreciate what you were able to share. Very useful, very helpful for business owners. And next, I want to transition now to a gentleman that I've known for several years, who is all retirement planning for us. And Howard Martinez is our qualified plan efforts, is heads up those efforts for Kinecta Wealth, and has done that for a long time for us and very successfully. So Howard's got some interesting information for us, and Howard, I'll let you take it away.
Thank you, Paul. Good morning, everybody. We're happy to welcome you to our seminar. And what we want to do is provide our members with access to the best resources available. And that would include hiring the best people in the community. These people will be the face of your franchise. They are the reason people will work with you. And they will be the reason customers come back and tell others about you. So it's very important to hire the best people you can and then keep them once they're in the door. So the question we're propounding is, what makes your company the place where the best people want to work? Is it because you offer the highest wages? Possibly. But would it help if you created a work environment that was attractive, including a solid benefit plan that would also feature and even highlight an easy to understand, generous retirement program? What we found in working with businesses and companies is that there are two groups looking for retirement plans: those who want a plan and those who have a plan but want a good one. And the question would be then, how can I make my plan better? Or what do I need to know about plans that are available? Attracting people is what you want to do, creating that positive work environment, separating yourself from others who do what you do, and then creating a situation for yourself. So when the time comes, you've got adequate retirement savings in order to continue your standard of living. In addition, we want to make sure that our plans comply with state mandates. Let's take a look at our next slide, please. To get started, we would do a meeting with you individually to help determine your objectives, goals, what it is you'd like to do, and discuss with you plan features and benefits that are available. We had a gentleman approach us earlier this week, a very, very successful pharmacist, and he had this idea for how he wanted to create his plan. Unfortunately, the government was not willing to play ball with his ideas. And he had an idea of putting aside a lot of money, which is great, but there are certain features and benefits that the employers are required to do to protect their employees. So this is an example of why we would want to meet with you. And then what we do is talk about what kind of features and benefits are available. We'd help you manage your plan by selecting the proper investments and then manage them by overseeing them to make sure that year by year they're performing properly. A plan may or may not include a match. Some employers are thinking, well, I don't want to do a 401k plan, for example, because I have to do a match. And that is a misconception. So we'll help you understand how the plans can work, how you can protect yourself, benefit your people, and then train your employees to participate, understand, and utilize the programs available for proper investing. Next slide, please. As we mentioned, we will monitor the investments in the plan. We go through a serious process of selecting the funds and then making sure that they are adequate and available. We'll also meet with you periodically, usually on an annual basis, to review the plan. How's it working? Do people have questions? Do they feel educated? Do we need to provide more education? What if you hire people along the way who maybe are in between meetings and they need help enrolling? Well, we have methods and means in which we can help educate your people and take that off your plate. The last thing you want is for an employee to ask you about investments for his or her retirement plan and put you on the spot as to what would you do. The danger there being, if you give them advice and their plan blows up, you might be held liable. So we want to remove that from your plate altogether. And we do that through education, which might include in-person, virtual enrollment and education meetings, and which we will feature the benefits and highlight the employer's goodwill. We want to make you look like the star that you are for providing this benefit plan. And one of our features and objectives when we're done with our plan meetings is to make sure the employees feel good about what their employer did in providing them an opportunity to be educated. Next slide, please. Continuous monitoring of the plan is very important. So we want to make sure that your employees are receiving regular information. One way we'll do that is through a quarterly newsletter available both in English as well as in Spanish. This is information that can be passed along to your employees at no additional cost. It can be done virtually, electronically, and provide questions to things such as, who should be my beneficiary? What happens to my money if I leave? What if something happens to the company? What if they go out of business? How is my retirement savings going to be protected? Or will it be protected? These are all common questions we hear in our education meetings, and we want to make sure that your employees get adequate answers and information. In addition, what happens to you if an employee terminates? How is that treated? Is there any additional liability that you need to worry about if you have an employee that no longer works for you, but has money in the company retirement plan? So we'll work with you on making sure that those folks are taken care of. Finally, we'll help compare the cost of competing plans. Not all plans are the same. We want to help make sure that you get the one that works best for you. If you take a look, there's a QR code in the lower left. You can take a picture of that, and it'll take you right to what we call a plan sponsor survey. Maybe you have a plan, but you're not really sure if it's doing the job it's supposed to do. There will be some helpful and easy to understand questions that will help you diagnose the viability of your plan. For example, have you met with your advisor recently to review the funds? Has there been education provided for your people? Are there language issues or barriers that prevent certain groups in your employee base from understanding and participating? These are all things that can help you determine whether or not your plan is doing what it's supposed to be doing. And if you find that it looks like you need some help, that's what we're here for, to provide additional assistance. Let's move to the next slide, please. So, where do your concerns lie? What keeps you awake at night wondering about your plan? Is it the administrative process? Probably you open business to make money, to make a living and provide for your family. The last thing you want to do is become an administrative secretary worrying about a retirement plan when you're supposed to be worrying about how to get the next customer. So what we want to do is streamline the process, help team you up with programs and resources that will help you make sure that your plan is working appropriately. We'll work with your payroll provider, whoever that is, to make sure that they understand deductions as well as any match that might take place. One administrative source of concern was, what happens if my employees change their deduction amount? How will I know how to increase or keep up with the match? These are very good questions and questions we want to make sure that you have adequate response to. We'll help you communicate the plan and drive participation. One way you can tell if your plan is good is by determining what is the percentage. For example, you have 100 people that work for you and 20 people are in the plan. Is a 20% enrollment and response to what you're trying to do adequate? Or do you think it should be up around 70 or 80%? There's actually administrative data available in which we can look at companies in your industry and actually tell you what the average participation should be. These are all areas in which we want to help make sure your plan is viable. Make sure that the plan is running according to government guidelines so that if an audit occurs, you're in good shape. Next slide, please. So, some of the options that are now becoming increasingly mandated, and you may have heard of CalSavers. CalSavers is a state mandated plan in which employers set up this plan, which is essentially a Roth IRA. It starts off with automatic enrollment in which employees are going to contribute 5% deducted from their gross pay. The employers are required to offer this plan if they have over 5 employees. So if you're not using a 401k or a 403b, you want to make sure that you're taking advantage of the Cal Savers program. It's available to you at no cost, but there are some limitations. For example, if you're under 50, you can only put in up to $6,500 per year. If you're over 50 years of age, the maximum is $7,500 per year. On the other hand, 401k or a 403b will enable an employee to put up to $22,500 if he is under age 50, and if over age 50, up to $30,000 under current regulations. So it's 3 times as much the 401k can offer an employee as far as putting away. And this does not include any employer match. So for more information, you can contact us on the Cal Savers, or you can go right to their website and get more helpful information. Next slide, please. Some options available for you. As you can see here in this graphic, there are several different programs that will satisfy the Cal Savers mandate. But in this graphic, you can see that there are limitations to contribution amounts. You have the Cal Savers program, which is available at no cost, 401k, simple IRA, and simple 401k. All have varying benefits, but we tend to find that the 401k and the 403b, which is like a 401k, but it's available for not-for-profit organizations. But as you can see here, that there are some limitations here on contribution amounts. There is not much flexibility with the Cal Savers. It's one plan and one size must fit all. And there's a lot more flexibility with contribution amounts and amounts that an employer can put away for him or herself. Next slide, please. If you have some questions, we'd be happy to make ourselves available either at the end of the program, or if you'd like to jot down our information, you can take a look at my email address or my phone number and feel free to schedule an appointment. We'd be happy to set up a Zoom visit or an in-person visit if you like, to make sure that we get your questions answered. Thanks very much. Paul, back to you.
Thanks so much, Howard. Excellent presentation. Thanks for joining us today. So next, and moving right along, we want to talk to Matt Fuller and Dana Hills. Both of them represent the Fuller Agency and help our small business lenders and our small business clients with their property and casualty needs. So I'll turn it over to Matt and Dana.
Well, thank you very much. Very much appreciate the opportunity. To tell you a little bit about me, about 40 years ago, I started in the apartment business to put together a program for property owners, large apartment association. I've been doing that ever since. We deal with lenders, management companies, and small mom and pops, and working with Kinecta over the years to help their clients. Next slide, please. And I just want to say that Dana's here. She's going to be the brain trust for everything non-property driven if there's questions. So, and she looks a lot better than I do. So I just want to say that. I'd like to talk a little bit about the changing insurance landscape that's out there and try to help you in the marketplace. It's no longer like it used to be. The last 2 years are probably the most challenging in the insurance environment that I've seen in the 40 years. You've probably heard a lot on the news recently about several large direct writing carriers that have left writing business, left the state of California. And we are somewhat in a turmoil situation. So it affects both personal, that's your home and your auto, and I'm sure you're seeing huge increases. Carriers are actually leaving the state, which limits the amount of flexibility that agents like myself have to find coverage. Stricter guidelines, and this is very, very important that you, for property owners, they take a look at the updating of their plumbing, heating, electrical, and roofs. Insurance companies now, unfortunately, kind of look in buildings over 40 years old, almost like actors and actresses. The only difference is that you can take a building that's over 40 and make it younger. You can't make someone like me younger. So, property owners, the key here is they're looking at a lot of reducing coverages if you have older buildings. So you have to be cognizant of that. We're seeing price increases starting from 15% and going up as high as 100% higher. I've had clients, they're calling me on a shock factor when they see rates going up 10%. And I said, please just pay those. But if you have to move to sometimes the non-standard markets, if the companies are leaving, you're seeing huge increases. And for that, you need to make sure you keep good records on your plumbing, heating, electrical, and roofs to make your building acceptable going forward. This is also on the commercial side for businesses. We're seeing a tremendous amount of closed zip codes all up and down the state. A lot has to do with the wildfire concerns, or the companies are just oversaturated in a given area. And so because of that, we're seeing huge non-renewals and cancellations on the rise. So what I do suggest that anybody that's taking out a new loan, that you really start shopping your insurance as soon as you sign up with Ryan or Joe on one of their loans. Look at insurance. It's not like it used to be. Next slide, please. And like I said here, it's no longer about price. It's about finding the right coverage. As agents, we used to compete for your business. You'd call up and say, last year I paid this, and we try to match with better coverage and better price. Now we're finding it just to find you coverage is important. And so we need your help as much as your documentation that you have. And I want to drive the next part of the slide is don't let your insurance lap on your home and your auto. Carriers can't get price increases, and they're finding any way they can to either minimize their exposure going forward. And so if you don't make a payment on your policy and it lapses even for a day, they're having you start the entire re-underwriting process. So my suggestion is to make your payments on time, maybe even set up with a payment plan from your company that would make sure your payments are on time, automatically done, electronic transfers, instead of putting that bill on your desk and waiting to pay it at some point, find out it's a day late, or the post office did not get there in time. Next slide. And I will have to say on seminars I've given that, are you prepared for the unexpected? I will have to say that most people know more about their favorite wine they drink, the sports team, now that it's fantasy football and football season, than the insurance policy that protects all of their assets. And it's one of those things that if you want to sleep at night, you read an insurance policy. But the problem being is you have all your assets covered on those policies. A lot of times you don't know what is or what isn't covered. In the past, you might have thought all the policies when they're saying when they're not. And if we only had a crystal ball, you'd know what you have versus what you need. But it's going to take your insurance agent to tell you that, because we just tend to look at price for the most part. And there was always TV commercials, and maybe they're not there now, but says 15 minutes can save you 15% on your insurance cost. I think that needs to be changed and say 15 minutes to do an annual review by yourself or your agent could save you millions by missing coverage. We're seeing tremendous amount of lawsuits now after COVID. There's more lawsuits coming, more natural disasters you're seeing every month on TV. Car accidents, theft, fire, water damage, earthquakes around the world. There's floods, dog bite. Cyber is now the new big hot button that's out there. You're seeing situations in Las Vegas that just occurred. Small businesses probably should look at to make sure that you have cyber coverage, product liability to make sure it follows your product, and it moves across the country, work-related accidents, and it just goes on and on. Next slide, please. I like to talk to business owners about, the policies you have. I don't think anybody realizes how many they have until you sit down and open up your drawer. Some of you have 2 policies, some have 5, some have more than 10. It gets a little cumbersome. And I like to briefly talk about, your building. We work a lot with like Joe and Ryan when they give you a loan on your property. What kind of building coverage you have? What kind of contents? Can you replace it? You need to look at your general liability coverage. EPLI, Howard was talking about how he has the benefit package. But what if you missed somebody? You have a new hire that you missed, and you have everything set up, but you just forgot one. Okay, that's employee practices liability would come in to protect you on that business side. Cyber, if you take anything on the internet, take transactions, have a website, they shut you down. I have my dentist the other day, well, not the other day, last year. She got broken into and her entire operation was held hostage. She had nothing. As we move to our technology base, everything is on computers. And if they hold you hostage on that, how are you going to start your business the next day? Cyber coverage is key. Earthquake and flood, you see that daily on the news. Workers' comp, the really thing you need to look at the workers' comp is, do you have W-2 employees versus 1099? So your workers' comp needs to be covered properly on those. Business auto, if you don't have the right coverage on business auto and it's not scheduled 1, 2, or 9, you got to ask your agent. The problem being on that is you might miss the non-owned auto coverage. You rent a vehicle, get in an accident, there's no coverage. So the key going forward is I really would like everybody to take a look at their policies. And then on your home, your auto, don't forget your personal line side. And an umbrella policy is key. So if I can go to the next slide. I like to talk about some of the 10 key coverages, and I know there's a lot to talk about insurance, and I'm trying to get through it quickly. But the key is replacement cost versus ACV, actual cash value. You need to make sure that's on your policy. See if you can get extended replacement cost, at least 125%. A lot of companies that Ryan and Joe will tell you they don't want co-insurance clause, but this gives you a little buffer above that amount. There's special form versus basic. That doesn't mean anything except basic is just what it says. We're going to give you a number of coverages that's spelled out. Special form is everything other than those that may occur, maybe even the invasion of the blob hit your building. That would be covered under special form. Basic form, it doesn't cover, the invasion of the blob, sorry, no coverage. I really suggest you take a look at how much loss of income you have on your properties. I suggest at least 24 months. If there's a natural disaster, it's going to take a lot longer. Just see what's going to happen in Hawaii. It's going to take years before anything gets built. If you just had 12 months coverage, you're going to be, looking around going, I can't replace this for years.
And Matt, real quickly on the business income, when sometimes you ask clients what amount do they want to put in, and they really don't know. There are worksheets available that a business owner could fill out that would really help them understand and the amount that they really need. Some policies are actual loss sustained, but a lot of them, there are a lot that are not actual loss sustained anymore, especially when you go to the E&S side.
Absolutely. The next coverage, building ordinance, that's key if you have any property, if you own an apartment building, an office building, shopping center, everything in California, for the most part, is getting older unless some of the new areas, and you're lucky enough to buy a new building. But the building ordinance coverage, if you have a loss, let's say in the city says 50% or more gets damaged in the location, you have to knock down the undamaged portion of your building. And then you've got to demolish that somehow, and you got to pay for all the new increased cost of construction, which may be height requirements, setbacks, sprinklers, all the ADA requirements. So if you don't have building ordinance on that, your insurance policy is going to pay you what's stated on the amount, but not what you need. So that's key. I would definitely ask your agent if you have those and the right amount of coverage. Same thing, backing up with sewers and drains. The insurance companies give it to you in the big print, they take it away in the little print. If you don't have these certain small coverages, you don't have coverage at all, along with mechanical breakdown. And today, a lot of buildings have electrical systems everywhere. I don't care if you've got elevators, security systems, keypads coming in. If the power goes out and those get fried along with your computer systems, you need mechanical breakdown. Employee dishonesty, it's pretty much self-explanatory. If they're stealing from you electronically or such, or if they're putting rent, they're charging rent to a building that you didn't know you were getting, that the manager was stealing, that's employee dishonesty. Money and security, someone steals money from you. And then the liability section for just general liability, if somebody trips and falls. Professional, if you have contracts or if you screw up and didn't do something correctly and you made a mistake, that's under professional liability. That's a separate policy. And the same thing in EPLI. Next screen. I didn't really want to talk much about this except the 3 forms or basic form, special, and you can see the different limits going across. The funny thing is if you ask your agent for 3 quotes like this, the difference in price might only be 10%, but the last column, you're getting twice as much covered on liability, full building ordinance coverage, business income at 24%, replacement cost at 125. So don't always just look at the price that you have, look at the coverage you have. So no 2 policies are the same. And I stress today, look at coverage more than anything. And I know we're all driven by price, but take a look at what the price that you're getting, because that's very important. It's sort of like the difference between a Ford and a Ferrari. You know, they both start with F, both have 4 wheels, both have the same sort of emblem, but they're not the same car. And same thing with insurance. Next slide. And I like to somewhat sum up with an umbrella liability policy. I think that's the best price that you can get out there for both personal and commercial. We have limits between $1 million and $100 million for property owners or business owners that need that. It covers your business and also your home and auto. You may have to have 2 different policies depending on how you take title to your properties. Your underlying limits typically at the bottom. A homeowner, you have to have 300,000 for your primary carrier, your auto 250, 500, and a business at $1 million. There's, like I said, the best price for the protection. Next slide. And I do want to say that the first line of defense on you is you. You need to know what you have versus what's going to happen at the time of a loss. You don't want to find out at the time of a claim you don't have some coverage just because you could have got it for a small price. Be proactive. Take the time to review your insurance policies. And I like to say there was a movie in 1996 called Jerry Maguire. And it wasn't necessarily show me the money that was the tagline that I remembered. It was more from, it was help me help you. And I think you need to do that. You need to help yourself with your insurance agent or someone like myself and Dana to help you have the insurance protection on your business and on your income properties, the right coverage for the right price, and be proactive on keeping track of all your records, because today it is no longer about us trying to compete for the policies on price. We need to sell that to our underwriters that are looking through ivory towers. And I very much like you and to take a look at your property on Google or Bing. Just put up your address, your business, how it looks on your website, because the underwriters that are sitting in an ivory tower in an insurance company someplace or in this country, that's the image they have. And there are no secrets anymore. There's so much technology out there. They know a lot more about you than you want to tell about them. And the underwriter, we have to sell them on your coverage. And if Ryan or Joe or Howard are giving you the policies, we need to sell to the insurance company to protect your assets going forward. And so you need to work with the agents going forward. And I want to thank you for your time. And Dana, if you have anything else you'd like to say, I know they might ask you a lot of questions. So.
No, I think you kind of summed that up. But again, we are here. So if you need any, you have any questions about your insurance or want a review, we'll be more than happy to assist the business owners and so forth. So that's about it.
Thank you very much. I appreciate it.
All right. Well, thank you both, Matt and Dana. Some very helpful and interesting information you spread. And Matt, you talked about the cyber attack in Las Vegas. I'm actually here, and I was a victim of that. I was staying at one of the MGM properties, and as you know, MGM was attacked globally on that. And so as a result, I'm sitting here in a library in downtown Las Vegas, and as you can imagine, all by myself. There's not a lot of not a lot of usage for the library here in Las Vegas. So I'll go ahead and start my portion, and it's kind of a delineation between what Matt was just kind enough to share with us and what I do, especially as it relates to you or business owners. With the business owners, first of all, I'll back up and tell you a little bit about myself. I've been in this business for 35 years and worked an awful lot with individual clients and business owners. And I help them to protect their businesses, their personal retirement, their legacies, and most importantly, their families. And typically that is done with life insurance, with long-term care. But today we're going to talk about the advantages that life insurance provides as a funding vehicle to take care of some of the issues that you might run across as an owner if you haven't already. So if we could, let's go to the next slide. I'm going to talk about what we call the big four, two of which we're going to focus on today, and then later I'll go through some of the others. The executive compensation, Howard touched upon that today, but there are also some life insurance funded opportunities there, and then estate taxes are always an issue for us. But today we're going to focus primarily on the business continuation and the key person issues, both again properly funded by life insurance. So next slide, please. In the business continuation realm, we use, and some of you may already have in place, in fact, maybe all of you do, a buy-sell agreement, or you've been able to pick out a key person that is very critical to the business operation, and without them, you would be in a bad spot. So we're going to talk about how to protect you if you are to lose through death or disability that key person, or if you were to lose one of your key people from a number of different things. And if we can, let's go to the next slide, and I'll talk about those triggering events that cause those. So for the business sell, buy-sell agreements, there are two types. And again, most of you may know that. It's either one where the business owners themselves, usually in a partnership, or maybe a different corporation, where the owners themselves will protect themselves and hold a policy on the other owners. So if you have two, one holds on one holds it on the other. And then the other possibility would be an entity purchase, where the business itself is purchasing that. Some advantages and disadvantages to both. But the purpose of doing this is to prohibit transfers. So if you have one of the owners that maybe decide that they want to gift some of their ownership, some of their stock to someone that you're not wanting to have involved in the business and the decisions made by the business, or you just don't want to have to come up with the liquidity to pay for that gift at a bad time, you normally will set up something like this to protect yourself. Other sales that would happen at retirement or somebody leaving the business, it gives you the right with a cross purchase or entity purchase by sell agreement, gives you the opportunity to have right of first refusal. So you're able to look at it. If it's not in the best interest in the business and for you, then you're going to have an opportunity to pull out liquidity and pay them as designed prior to the actual event. So we're also going to look at some of the mechanisms to set up the sale, how you would set that up. And then, the bottom line for this is always providing liquidity. Cash is king to you. Having working capital at all times to do what you do best, which is to keep your business going and to expand upon that. If one of these events were to happen to one of the owners and you'd have to pull out a large sum of money from the organization, of course, it's always at the worst time, and can cause the organization to slow or even stop permanently. Next slide, please. So we look at what we call the 4 Ds. These are again the specific triggering events, being death, disability, departure for resignation, retirement, or somebody that's terminated. Divorce is a big one, and then one more we're going to add, which would be bankruptcy. Death is probably the most focused upon for this reason. At the death of one of the primary owners, if you can imagine what that would cause, the sudden death, heart attack is frequent. That the liquidity needed to pay out their portion of the ownership to their heirs is typically immediate, and can cause a large disruption in what the short-term and long-term plans are for the business. Disability as well, depending on the disability, there's a lot of, we're all very active. I mean, I was out at my age skiing in Utah over my birthday a couple of months ago, and enjoyed that, and had a fall, and I thought, that's something like this happens quite frequently. We see a lot of mountain biking accidents actually here in California, and that causes some of these issues. But the idea of a resignation, someone seeing another opportunity, is primarily the reason for that, or if their ideas are not in line with the rest of the owners and they want to leave. Again, and to do that, unless you have agreements set and put in place and determined how to fund that, you may have to be able to pull out a large sum of capital and pay them up front. Same with retirement, same with termination. The big one, though, that where a lot of concern comes from is divorce. And these can't be planned, but unfortunately they happen quite often. If we're talking north of 50% for divorces in today's environment, and considering that the spouse can come in and say, I want my half of that portion of the business and I want that right away, without a contingency set in place, a plan put in place that both determines how that's going to happen and how to fund it, can cause a great deal of problems for the business. And then the final one is bankruptcy, personal bankruptcy, meaning that creditors are going to come towards you, and how do you protect yourself from that? This is an excellent way to do that. The 4 ways to pay for this would be cash out of pocket on a dollar for dollar basis, and this is usually something that's up front. Again, if cash is as important to you as it is to most of the business owners I work with, maybe not something that you want to do. You don't want to take out a large lump sum and pay that over at a time that you may not want to do it. Installment sale. Not a bad opportunity there, but you're doing it on a dollar for dollar basis. So every dollar that you pay for that sale, maybe it's more palatable to be able to do that over time. But it also means that you're taking all that money directly out of the business. Loans, another possibility, not a bad option because you can set it over time, but remember there's interest to be paid. And of course, we're in an interest rate environment where those loans aren't as attractive today as they were several months ago. And then finally, the option we've been talking about, insurance, both life and disability. What that allows you to do is you're going to, instead of paying cash all at once, you're going to pay it in premiums over time. And it's the leverage effect that gives you the best opportunity, where you can put in a little into those policies, but then a great deal come back to fund the need at the end of life or for someone's disability. Next slide, please. So I said I was going to look at the 2 and show you how that works. This kind of takes it into detail. So for the cross purchase, again, not the company, but the owners will buy a policy on each other, and it will protect them from the issues that we talked about, death, disability, divorce being the largest one. And on this, for an estate planning perspective, especially at death, there is a step up in basis, meaning that that's going to come across as a tax-free sum of money to back to the business itself. Next slide, please. The other possibility here is the entity purchase, where the company is buying it, and can be done over time. It used to be a tax advantage for doing that in terms of the premium, not today, but again, there's the large leverage effect of paying premiums that are going to provide a much larger amount at the event of the death or disability or whatever the triggering event might happen. If the company purchases, there would not be a step up in basis. Whatever the value is going to be that's stated that would be paid out at death or disability, that's the amount that we receive. If they're going to have anything grow in that insurance policy, whether it be a life insurance policy or disability, if there's growth from that, they would have to pay the taxes on the growth from when they started. That's the difference between the 2 purchase types. And then go ahead, if you would, and move to the next slide. All right, key person. Question is who? And as you go through the analysis of who you want to do, it would normally be those who started or founded the business, had the ideas, divvied up what the accountabilities are going to be in the organization, what their responsibilities would be, and knowing that if one of those were to depart either through death or disability, there'd be a problem with that. And you need to have some capital come in to help you find a replacement over time. And if you need to have a replacement, you have to be able to keep the cash flow going over the time it takes to find somebody to be able to be replaced. But also the signing bonus, you may have some additional capital needs there. And you can do this for death or disability on that key person. The big one, and I kind of talked about some of the issues that are out there for those of us who are maybe aging and still feel like we're in our 20s, and we're out actively participating in sport. Disability is on the rise. And if it's a full disability and they're not able to do what they normally would do, you need to have some capital to perhaps bring somebody in to help and fill in the gap. Next slide, please. So with this, I'll not only wrap up my own remarks, my formal remarks, and say to you that I know we touched upon a number of issues that I described. I'd like to have conversations with those of you that either have, especially buy-sell agreements already in place. As you know, it's a very good idea to review those every year or two. I'd like to help with that. Or for those that do not and are putting a business together or have had one for some time and realize that you may be putting yourself at risk because of the issues we discussed, love to talk to you about that as well.